Hi everyone, this is Devins Financial Weekly Stock Analysis Newsletter. Today is February 16, 2013. Our newsletter is for your informational purpose only. We're not responsible for your gains and losses. Let's look at current market trend and our strategy. US stock market has little change last week. It remains in the uptrend. China stock market closed last week due to Spring Festival. My plan is continue long the market through ETFs and stocks. Let's take a look at major stock market index chart. The first is NASDAQ daily chart. NASDAQ is in the uptrend. Mid cap weekly chart. It broke out the 2-year base last year, end of last year, and it's going up. Mid cap daily chart is in the uptrend. Russell 2000 weekly chart. It broke out the 2-year base going up. Russell 2000 daily chart is in the uptrend. SP 500 daily chart is in uptrend. Shanghai Stock Exchange market closed last week. Gold index daily chart. Gold is in a downtrend. It broke down the previous support 1626 and it's heading down. Silver daily chart is in a downtrend. US dollar. Long term is in a downtrend. Short term is rebounding. Crude oil. Crude oil is in the uptrend, but it needs to hold above 95. If it breaks down 95, it will heading down. And the recent peak did not break the previous high, so this is cautious. GDX is a gold mining stock. It's in a very strong downtrend. IYR is a real estate ETF. It's in the uptrend. This is energy ETF. Is in the uptrend. Financial ETF is in a very strong uptrend. XME is a metals and minings ETF. Is making a base. I'd like to share with you a couple stocks that we need to avoid for the time being. Those are the stocks had either breakdown 50-day moving average with a high volume, or they're overextended and they show the signs of institution distribution. Apple is one of it, and the two 3D printing company, SSYS and DDD, currently they have shown distribution signs. And I'd like to share with you the stocks continue hold. Those are the stocks that I previously introduced to you in the Devins Financial newsletter. If you previously bought them at the proper buy point, you can continue hold them. However, those are stocks has gone up a lot. They don't have new buy point. If you haven't bought it yet, you should wait for the next proper buy point, such as breaking out from a new base or rebound from a 50-day moving average. ARM Holdings is one of it. Celgene, LinkedIn, PRLB, and the NSM. I'd like to share with you something about gap up. Gap up is caused by overnight events such as strong earnings, FDA approved. And second day, stock opened up with a gap and the price jump due to the strong demand. Depends on the stock price move prior to the gap. You have a breakout gap, which is a breakout from a base and with a gap, such as ARM Holdings. This is a very strong buy signal. And then you have a continuation gap. The stock already broken out from a base, and then it gap up again. And this is a hold signal. If you have bought it from the previous breakout, you can continue hold. And then there's an exhaustion gap. The stock has gone up a lot before the gap, such as 50 to 100% gain, and it has gone up for extended period of time, and the price has overextended. And then the gap is a one last jump. Those are the very high risk, and those are actually a sell signal. It's not a buy signal. And then there are two types of gaps. One is a breakaway gaps, and another is a filled gaps. The breakaway gaps is due to extremely high demand. Stock price never look back once they jump up. And the filled gaps, the demand is not as strong as a breakaway gap. And this they're still treatable, but you have to wait until it fills the gap and then rebound again. Then that's a buy signal. But you don't know whether a gap is a breakaway gap or fill gap. How do you treat it? How do you treat the gap in general? First of all, do not buy the exhaustion gap, and it's a sell signal. And uh, if it's a breakout gap, if the stock made a base, then break out again, or it's a continuation gap, those are the buyable gap. And then since you don't know whether the gap is a breakaway gap or it's a filled gap, what you need to do is just buy the stock at the market open of the gap up day and use the gap up point and the stop order. Put a stop order just below the gap up point. If it's a breakaway gap, the stop order will not be triggered. You will just continue hold it and move up your stock price as the stock goes up. For the filled gap, the stop will be triggered. You will be out of the stock, and then you wait for the gap to be filled and buy back if it rebound after fills the gap. Let's look at some example. ARM Holdings, last year on end of December, after report earning, ARM Holdings gap up. It break out a 2-year flat base and with a gap with a high volume. This is a very bullish sign, and the stock never look back after a gap up. It's currently still in the uptrend. So this gap up is a buy signal. FLT is a financial stock. Recently gap up after report earning. However, look at this stock. It has gone up for 6 months and price has gained more than 50%. And since they had the last buy signal here, the last gap up, this is a buyable. This is a breaking out from the base. However, since this gap up, it has gone up 50% and then gap up again. This gap up, the price has jumped out of the upper channel of the uptrend. This is the upper channel, the blue dashed line. This upper channel uptrend, the stock jumped above it. That's indication the price is a little overextended. And if you buy here, the risk is kind of high. So this stock is on my watch list, but I would not buy it. Michael Kors, and it recently break out from the base. However, after breakout, it pulled back from the support and 50-day moving average with a high volume. This 50-day moving average is a buy point. If you buy it here, you probably have already get triggered out after a breakout and pull back 8%. You get triggered, you get stopped out. You probably stop price get triggered. You probably got stopped out, and then 50-day moving average is another buy point. If you haven't bought it yet, this gap up is actually a buyable gap. It's a continuation gap up, and it's a breakaway gap. Looks like it's not going to fill this gap, so the price looks like it's going to continue go up. LinkedIn, and also it's a continuation gap. It break out the cap with the handle here. Here's a cap. Here's a handle. It break out the cap with the handle right here with a high volume, and then continue go up after earning stock gap up and with a very strong demand. Look at this volume here. This is a breakaway gap. It's a continuation gap. So it is buyable right here at 140. If you put a stop below 140, the stop will not be triggered. Stock just continue goes up. You move up your stock price. LinkedIn is a very big stock, has a very strong institution demand. Mellanox looks at last year, and this is also due to earning stock gap up, and this is a breakaway gap. Never look back. The stock continue goes up, and the gap up again. The gap did not get filled. I mean, it barely touched the lower part of the gap, and then goes back up again, and then went up 20%. And this is a sell signal. Stock gap down with a high volume. It's a very strong sell signal. And linger around this area, fill the gap, and gap down again. So when the stock gap down, it's a reverse of gap up. So you gotta sell. And then now it's in a very strong downtrend. Netflix recently gap up after earning. This is a breakaway gap, continuation gap. It has already made a base previously. You see the volume when they on the up days, there's a strong volume. That's a institution demand. And this is a breakaway gap. Now it's in the uptrend. NSM, this is a filled gap. The stock gap up due to some kind of earning. They bought a whole bunch of the mortgage security or something. And then the stock gap up on that day, but after it gap up, stock came down to fill the gap. So if you buy on the gap up, put a stop order just below the gap, your stop order get triggered, you will be out of stock right here. However, the stock after fill the gap, it came back up again. Then this give you another re-entry point. So right now it's in the uptrend. PR, PRLB is a 3D printing company. And the stock breakout here from the base. This is your breakout point. And after breakout, it pull back a little bit, but found support and 50-day moving average. After earning report, a gap up. This gap up $46, around $46, $47. That is a trigger point to buy. If you buy here, you probably come back down again, but I mean, right now it looks like it's about to fill the gap. Looks like this gap may be filled. So you may be triggered to sell right here and without making any money if you didn't sell at the top. But this stock worth to watch. We will see after it fill the gap what's gonna do next. And then there's a gap down. As I shared with you, the gap down with a high volume is an indication there's a strong distribution. The institutions are selling those stocks and avoid long any stock that gap down. If you know how those stocks may be a short candidate,